So if you're an early stage founder, you are going to hear the term valuation cap a lot, like a whole lot. But what does it actually mean for you and for the company you're pouring everything into? Let's dig in and figure out what this number really means for your future.
And look, on the surface, it seems simple enough, right? It's just one number on a term sheet. Another piece of jargon to learn while you're trying to build a company. It's so easy to just kind of gloss over it, agree to whatever seems standard, and just move on.
Because that's the thing, that's the reality. This one little number has a massive and often really delayed impact on your ownership. It can silently carve away a huge piece of your company long before you even start thinking about your next funding round. The stakes, they're incredibly high.
And that's exactly what we're going to do here. We are going to pull back the curtain on the valuation cap, demystify how it actually works, and give you a framework to think about it strategically. The goal is to help you raise smart, not just fast.
Okay, so first things first, let's get a really clear definition. What exactly is a valuation cap? Well, at its core, you can just think of it as a ceiling. To really get this, you have to remember one key thing. Early investors who use a safe or a convertible note, they aren't buying shares today. They're buying the right to get shares in the future. The valuation cap sets the absolute maximum price they will pay for those shares, no matter how high your company's valuation goes later on. It's their reward, really, for taking a big risk on you so early.
And this right here creates a huge gap between what people think is happening and what's actually happening. When you say you're raising on a $5 million cap, pretty much everyone hears, okay, this is a $5 million company. But that's not technically true. It's just a placeholder, a mechanism for a future conversion. The problem is it acts like a valuation and it sets expectations for everyone.
So you might be wondering, why even go through this whole complicated process? Well, because when you're just starting out, maybe you just have an idea, no product, no revenue, trying to put a price on your company is almost impossible. Safes with caps let you get the cash you need to grow, while pushing that difficult conversation about valuation down the road until you've actually made some real progress. It's all about flexibility.
But, and there's always a but, right? That flexibility comes at a cost, and that cost is calculated in your equity. This is where we get into the hidden math that, honestly, so many founders only understand after it's way too late.
Let's just walk through a classic scenario. Say you raise $250,000 on a safe with a $5 million cap. You do amazing work, and 6 months later, you raise a new round from new investors who value your company at $10 million. Great. Now those new investors, they're buying shares based on that $10 million price. But your early safe investor? Nope. Their money converts at the $5 million cap you agreed to ages ago. That means they are buying shares at half price, which means they get twice as many shares for the exact same amount of money.
And when you see that math play out visually, it really hits home. Suddenly, bam, that safe converts, and a whole new slice appears in your ownership pie. Your own stake just got smaller to make room for it. It doesn't happen when you cash that first check. It happens when you close the next round, and that's exactly why it's so easy to miscalculate the impact.
The dilution from a valuation cap is basically invisible until it becomes permanent. It's a future consequence for a decision you're making today, which is why thinking ahead is so critical.
Okay, so we understand the risk. The next logical question is, what do you do about it? How do you set the right cap? How do you find a number that's actually fair to you and your investors?
It really all comes down to this one fundamental trade-off. A lower cap that's more attractive to investors, no question. It can help you close your round a lot faster, but the price you pay is giving away more of your company down the line. A higher cap, on the other hand, protects your ownership, but it might make your round a lot harder and take way longer to close. There's no single right answer here, just the right answer for you and your situation.
Now, you're going to hear investors and other founders talk about the market rate for a cap. But let me tell you, the truth is, there's no official number. It's just what's common. And what's common is based on averages. Your startup is an average, and blindly following the herd here is how you end up giving away your upside just to fit in.
So the key takeaway is this. If you want a higher, more founder-friendly cap, you need to earn it. You need leverage. And you build leverage by reducing risk for your investors. Have you actually built a product? Have you talked to real users? Do you have any unique IP? The more progress you can show, the more you can justify a cap that actually reflects the value you've already created.
And this brings us to what I think is the most important mindset shift of all. The goal isn't just to get the highest cap possible. The real goal is to protect your long-term ownership.
See, your equity isn't just a number in a spreadsheet.
It's a strategic asset. It's the currency you're going to use to attract the best engineers, the best marketers, the best leaders, the people who will help you win. If you give away too much of it too early, you'll literally find yourself unable to afford the team you need to succeed.
This really is the bottom line. Once the safe converts, you can't go back. You can't renegotiate. You can't undo that dilution. The decisions you make about your valuation cap in these super early days, they will echo for the entire life of your company.
Ultimately, your valuation cap isn't just a number, it's a story. It's a story that tells investors how you value the progress you've made and the vision you're building. So, before you agree to any number, just ask yourself, is this the right story for the company I want to build? Is it a story of confidence, of leverage, and of a long-term vision? Because that's the story that attracts the right partners and keeps you in control of your own destiny.